Welcome to Nevada 2026, a state once defined by explosive growth, fast money, and a housing market that seemed almost untouchable. But something has changed. Right now across Nevada, home prices are not just slowing down. They are dropping in some places sharply, in others quietly, and in a few cities dramatically. We're talking about price cuts reaching 10, 20, even up to 40% from peak market highs. And the reasons? A mix of rising interest rates, cooling migration trends, oversupply in key areas, and a shift in what buyers actually want in 2026. But here's where it gets interesting. These price drops aren't happening randomly. They're happening in very specific cities, places that were once hot markets, now facing a new reality. Now before we dive in, like this video, so the algorithm knows you've stumbled on something worthwhile. Subscribe because someday you may want to relocate. And this channel is basically your break glass in case of emergency guide. And let me tell you, this is not surface level content. By the end of this video, you'll either be packing your bags or second guessing why life in these towns are changing so fast. Let's get into the countdown. 10 Fernley. Welcome to the front lines of the correction in Fernley, Nevada, where the golden era of the California escape has officially hit a brick wall. To understand why Fernley is our number 10 spot, you have to look at the sheer speed of the reversal. Just 2 years ago, this was a frenzy zone, but today the data tells a much grimmer story for sellers. So, we're looking at a median home sale price that's come down to about $399,000. That's honestly a pretty significant retreat from those peak highs we saw back when tech workers were pouring in from the Bay Area. But, the real pain is showing up in the price per square foot, which has now dipped toward $250 as inventory just starts to sit and, well, kind of rot. So why is this happening? It's really a perfect storm of logistics and liability. Fernley, as you might know, is basically the backbone of the region's warehouse and industrial sector. But now, as automation and AI-driven supply chains start to take over, those massive hiring sprees we saw in the early 20s have just evaporated. What we're left with is a workforce that simply can't afford a $450,000 mortgage on a 3-bedroom ranch anymore. And to make matters worse, there's this specific crisis with the new flood map designations, which have pushed homeowner insurance premiums into a vertical climb, basically adding hundreds of dollars to the monthly carrying cost of these homes. Now in the rental market, we're seeing this strange paradox. The average rent is still holding at about $1,618 a month for a 1-bedroom and nearly $2,400 for a 3-bedroom. But here's the thing, occupancy rates are starting to flicker. Landlords who bought at the top of the market in 2024 as cash flow investments are now finding themselves in the red, since they can't raise rents high enough to cover their high interest debt. And they're also having to compete with a surge of new apartment builds. If you look at the recent sales data from just this month, you'll see the desperation. We've tracked homes on Driver Court and Ruby Street that sat for over 60 days before the sellers finally blinked and slashed their prices by 5 to 10% just to get a signature. The sale-to-list price ratio is no longer a guaranteed 100%. In fact, nearly 40% of Fernley listings in 2026 have undergone at least one major price reduction of $20,000 or more. The bedroom community dream is being tested by the reality of a 70-mile round-trip commute to Reno and Sparks. When gas prices are volatile and remote work is being clawed back by corporate mandates, buyers who are still in the market are becoming incredibly picky, demanding that sellers cover all closing costs and buy down their interest rates to the 5% range. A move that effectively eats another $30,000 of the seller's equity. For investors, Fernley has shifted from a buy-and-hold paradise to a sell-before-it-sinks scenario. As the city struggles to transition from a rural outpost to a balanced residential hub, if you are watching the charts, the inventory of homes for sale has spiked by nearly 30% year over year, while the pool of qualified buyers has shrunk by half. This is the definition of a market correction in real time. The quiet streets of Lyon County are now echoing with the sound of falling equity. And as we move further into 2026, the gap between what a house is worth on paper and what a buyer will actually pay is widening into a canyon. Fernley is the warning shot for the rest of northern Nevada. The high-speed growth has run out of fuel, and the landing is looking anything but soft. Pahrump. The narrative of Pahrump being a safe haven for affordable living is being rewritten by a cold, hard statistical correction. To understand the gravity of the situation here, you have to look at the massive gap between what sellers want and what the market is actually paying. As of late March and early April 2026, the average home value in Pahrump is hovering around $368,640. The surface that looks like a small year-over-year increase, but the surface is lying to you. The real story is found in the median list price, which is still being pushed by hopeful sellers toward $399,783. This massive $40,000 disconnect is why the market has essentially frozen. Right now, homes in Pahrump are languishing on the market for an average of 79 days. That is nearly 3 months of waiting while equity evaporates. If you are a buyer in 2026, you are walking into a gold mine of leverage because a staggering 64% of all homes sold in Pahrump are closing under the list price. We are seeing a take whatever you can get mentality among sellers who are desperate to exit. The rental market is feeling the squeeze too. The average rent in Pahrump has slipped to $1,433 a month. A month-over-month decline that signals the budget alternative dream is cooling off. For a standard 3-bedroom home, you're looking at roughly $1,495. But even at those prices, landlords are seeing their properties sit vacant for longer periods. But why the drop? Why now? In 2026, Pahrump is dealing with a zombie lot crisis. Thousands of parcels that were once sold as investment land are being flagged as legally unbuildable due to shifting county rules and infrastructure bottlenecks. This has caused a panic among landholders who are now dumping their property at 40% discounts just to clear the tax liability. We've seen listings for manufactured homes on these fringe lots drop from $250,000 down to $169,000 in just a few months. Investors who are eyeing Pahrump for the short-term rental market are also hitting a wall. While there are over 70 active Airbnbs in town, the average occupancy rate has fallen to 37%. The revenue simply isn't there anymore for the small-time investor. With an average daily rate of $156, many are realizing that after taxes, cleaning fees, and high Nevada utility costs, they are losing money every month. This has led to a surge in for-sale inventory, which has climbed to over 320 active listings, a high number for a town of this size. New listings are hitting the market every week as people realize that the quiet desert life comes with the reality of a 70-mile commute to the Las Vegas Strip when gas prices are north of $4 a gallon. We are seeing specific price slashes on streets like Marywood Court and Montecito Drive, where 3-bedroom homes that were once untouchable are now seeing multiple price cuts of $20,000 and $30,000. For the people of Pahrump, 2026 is the year of the great rebalancing. The speculative frenzy that drove prices up in 2024 has been replaced by a buyer market where cash is king and patience is rewarded. If you are looking to buy in Pahrump right now, the smart money says to wait, because with nearly 2/3 of the market selling for less than asking, the bottom is still nowhere in sight. The cinematic silence of the Pump Valley is being broken by the sound of a housing bubble slowly and painfully letting out its air. Sliding into the number 8 spot, we hit the industrial heart of the valley, North Las Vegas. This isn't just a cooling market, it's a full-blown tug-of-war between aggressive new-build developers and panicked resale homeowners. If you're tracking the data for 2026, the numbers are flashing a warning light for sellers while screaming opportunity for buyers. The average home value in North Las Vegas has officially dipped to $47,047, a 4% decline compared to last year. But don't let that single-digit drop fool you. When you look at the median list price, which is currently sitting at $426,452, you realize there is a massive gap of nearly $20,000 between expectation and reality. In North Las Vegas, the days on market has stretched to an average of 50 days. But for many neighborhoods like Centennial Azure or the Shadows, homes are languishing far longer. The reality of 2026 is that 43% of homes are selling for less than their original list price. We are witnessing a surge in inventory with over 1,000 active listings, currently fighting for a dwindling pool of qualified buyers. This is a complete reversal from the bidding wars of 2024. The rental market is telling its own story of a correction. As of April 2026, the average rent in North Las Vegas has retreated to $1,131, marking a year-over-year decline. If you're looking at smaller units, the average rent for a one-bedroom has fallen 3.4% to $1,128. Landlords in neighborhoods like Aliante are feeling the pressure as the vacancy rates climb. For the first time in years, renters are seeing one-man-freeze signs appearing on apartment complexes along the North Beltway. We've tracked specific price drops in the master plan communities where homes that were listed at $500,000 in January are now being fire sold for $425,000 after 90 days of silence. The job market in North Las Vegas, while growing, has faced a shift. The initial gold rush of the industrial warehouses at Apex has matured, and the speculative hiring has leveled off with the unemployment rate in the Las Vegas Henderson, North Las Vegas metro area sitting around 5.8%, 8% in early 2026. The urgency for new housing has cooled significantly. Investors who flooded North Las Vegas looking for entry-level yields are now realizing that the math doesn't work at today's interest rates. This has led to a flood of investor-owned homes hitting the market all at once, creating a glut of inventory that is dragging down values in every zip code from 89030 to 8984. If you are a buyer, this is your time to be ruthless. The sale-to-list price ratio has fallen to 99%. And in many cases, buyers are successfully negotiating for the seller to pay for a new roof, HVAC repairs, or several years of HOA fees just to close the deal. North Las Vegas is a market in transition. The hype is faded, the industrial boom is priced in, and the correction is here to stay for the foreseeable future. Dropping into the number 7 spot, we find ourselves at the southernmost tip of the state in the riverfront retreat of the Laughlin. In 2026, Laughlin is a market defined by the Great Stagnation. While the rest of the country watches high-speed auctions, Laughlin is moving in slow motion, and the data for April 2026 is absolutely staggering. The average home value here has officially slipped to $259,679, down over 3% in the last 12 months alone. But here's the number that should make every seller's heart skip a beat. The median days on market has reached a grueling 112 days. That is nearly 4 months of waiting for a buyer to even walk through the front door. If you look at the median list price in Laughlin right now, it's hovering around $29,000. That is a massive retreat from the peaks of 2025. Why the sudden drop? In 2026, Laughlin is facing a demographic collision. This has long been a haven for retirees and seasonal snowbirds. But the cost of maintaining a second home or a retirement villa has skyrocketed. Between rising property taxes and the surging cost of desert climate control, the affordable Laughlin lifestyle is getting a reality check. We are seeing a surge in inventory with over 185 homes currently for sale, and the new listings are hitting the market faster than the sold signs are being printed. The rental market is perhaps the most dramatic indicator of the Laughlin shift. In April 2026, the average rent in Laughlin has cratered to just $99 a month. That is a massive 17.2% decrease in just 1 year. Landlords are slashing rents by over $150 a month just to keep their units from sitting vacant. For a standard 3-bedroom house, the average rent has settled at $1,210. But even then, the demand is cooling as the local casino and service-based economy faces its own headwinds. But the real red alert for Laughlin real estate in 2026 is the condo and townhome sector. We've tracked specific listings along South Needles Highway and the surrounding riverfront where units that were once valued at $300,000 are now being listed in the high 100s. Some of these properties are seeing 40% price cuts from their 2022 valuations as owners scramble to offload their HOA obligations. For a retiree on a fixed income, an HOA fee that jumped from $300 to $600 a month is a deal breaker, leading to a wave of forced liquidations. This is a cinematic buyer paradise if you have the stomach for it. But for current homeowners, Laughlin is a lesson in the dangers of a single industry economy. When the fund money dries up and the retirees stay home, the housing market is the first thing to lose its shine. Moving into the number 6 spot is Spring Valley. In 2026, this neighborhood is the literal ground zero for the clash between old-school Las Vegas and the new economic reality. For years, Spring Valley was the ultimate compromise, close enough to the Strip for a 10-minute commute, but suburban enough to raise a family. But in April 2026, that compromise is starting to look like a liability. The average home value in Spring Valley has retreated to $420,659, marking a year-over-year decline of nearly 4%. While other parts of the valley are seeing modest gains, Spring Valley is stuck in a downward slide that is catching both investors and homeowners off guard. When you look at the raw data for this month, the buyer market signal is screaming. The median list price is still being pushed by hopeful sellers at $450,000, but the actual closing prices are telling a different story entirely. Right now, homes in Spring Valley are taking an average of 65 days to move, a significant jump from the 56-day average we saw just a year ago. But here's the kicker. Over 68% of all sales in Spring Valley are now closing under the list price. That is nearly 7 out of every 10 transactions where the seller had to blink first. The sale-to-list ratio has dropped to 97.6%, meaning buyers are successfully shaving $10,000 to $20,000 off the price tag before they even sit down at the closing table. The rental market in Spring Valley is providing its own reality check. As of April 2026, the average rent has slipped to $119.50, representing a massive 6.9% decrease year over year. If you're a tenant, you're finally seeing some relief. But if you're an investor who bought a rental property here 2 years ago, you're likely staring at a negative cash flow situation. For a standard 3-bedroom home, the average rent has settled at $2,000, but we are seeing units in older complexes near Flamingo and Rainbow dropping as low as $2,300 just to keep the lights on. But what is driving this specific drop? It's the aging inventory crisis. In 2026, Spring Valley is filled with homes built in the 1970s and 80s that are hitting a wall. Buyers are no longer willing to pay $500,000 for a fix or upper when interest rates are high and modern. Energy-efficient builds are popping up just minutes away in Summerland. We are seeing a massive inventory surge with over 1,076 active listings currently on the market. That is a lot of stale inventory competing for the same pool of buyers. We've tracked specific price bloodbaths on streets like Dunville Street and West Twain Avenue, where 3-bedroom homes that were hot commodities in 2024 are now seeing price cuts of $40,000 and $50,000 after sitting for 90 days. One property recently closed for $583,000 after being listed at nearly $600,000, and it took 123 days to find that buyer. In 2026, Spring Valley is a market where the for sale sign stays up for months and the price-reduced banner is the most common decoration on the block. Sliding into the number 5 spot is Mesquite. In 2026, the oasis on the Virgin River is seeing its mirage start to fade. For years, Mesquite was the ultimate fallback plan for retirees and remote workers who found the Las Vegas Valley too chaotic and the Utah border too expensive. But as of April 2026, the data is painting a picture of a market that has officially transitioned from a seller's dream to a buyer's reality. The average home value in Mesquite has hit a plateau, settling around $448,000. While that sounds stable, it's the velocity of the market that should have homeowners worried. When you look at the sales data for April 2026, the sale-to-list price ratio has dipped to tight 96.6%. This means that on a standard $400,000 home, the average buyer is successfully negotiating at least $14,000 off the top before even discussing repairs. But the deeper bloodbath is in the high-end gated communities. We've tracked specific sales on my Ironwood Drive and White Waterway, where homes listed in the high 400s are closing for 10% under asking. After sitting for over 130 days in 2026, if a house isn't priced to perfection, it becomes a zombie listing that buyers simply ignore. The rental market in Mesquite is also signaling a massive shift. The average rent for all property types has retreated to $1,650, representing a 5% drop in just the last 30 days. If you're looking at apartment living, the average rent for a one-bedroom has fallen to $943, making it one of the most affordable and therefore most competitive rental markets in the state. However, for the luxury homes and golf villas, the rental demand has dried up. Landlords who expected to get $2,500 a month for a three-bedroom are now seeing their properties sit vacant for months, leading to a wave of rental to resale conversions that is only adding to the inventory glut. What is driving this correction in 2026? It's the watch retirement exodus. As the cost of living and property insurance in the desert continues to climb, the fixed income demographic that fueled Mesquite's growth is looking elsewhere or simply staying put. The speculative flippers who tried to capitalize on the Sun City Mesquite hype are now facing a wall of competition from new construction. Builders in the area are now offering massive incentives, including the legendary zero-down and rate-buy-down packages that are effectively dragging down the value of every existing home in the neighborhood. If you're walking the streets of Mesquite in 2026, the for sale signs are becoming a permanent fixture of the landscape. From the canyons of a PI Sun City to the older established neighborhoods near the casinos, the message is clear. The peak is over. Over to Yo, 78% of sales are now occurring under the list price, and the leverage has shifted entirely to the person with the checkbook. For buyers, Mesquite is finally becoming the bargain it was promised to be. But for sellers who bought in 2024, the climb back to equity is going to be a long, dry hike through the desert. The house doesn't always win in Mesquite anymore. In 2026, it's the buyer who is walking away with the jackpot. 4. Reno. Reno was once hailed as the next Silicon Valley, a high-desert utopia where tech giants like Tesla and Google set up shop, and the California exodus found its new home. Tech companies moved in, remote workers followed in droves, and the result was a housing market that didn't just grow, it exploded. But in 2026, the narrative isn't about the boom anymore. It's about the correction. We are seeing a major recalibration across the Truckee Meadows. In 2026, specific pockets of Reno have seen price declines ranging from 15 to as much as 30% from their speculative peaks, and the reasons they are layered, complex, and hitting all at once. The rapid tech expansion that defined the early 20s has hit a stabilization phase. The massive hiring sprees have slowed, and the Silicon Valley salaries that once made a $600,000 starter home seem reasonable are being scrutinized. Remote work trends have stabilized, but with a twist. Many companies are calling workers back to the office, and the nomadic laptop class that drove prices up is no longer entering the market with the same urgency. At the same time, the inventory drought has broken. We are seeing over 900 active listings on the market right now. A significant jump that is finally giving buyers the power of choice. Affordability has moved from a talking point to a full-blown crisis. Buyers are doing the math, looking at 6.8% interest rates and property taxes, and the math simply isn't working. When the average rent for a three-bedroom house is sitting at nearly $2,900, and the median home price is hovering around $567,000, the dream of ownership is being deferred. But don't mistake this for a death spiral. Reno still has incredible long-term potential. Its proximity to Lake Tahoe, its burgeoning healthcare sector, and its revamped infrastructure, like the $300 million airport expansion, remain massive pillars of strength. What we are witnessing in 2026 is less of a collapse and more of a necessary market correction. It's a return to reality after a period of unsustainable growth. For the first time in years, The for sale sign in Reno doesn't mean a bidding war. It means a conversation. The speculators are out, the realists are in, and the biggest little city is finally finding its balance again. In 2026, the smart money isn't chasing the peak, it's watching the correction. Stepping into the number 3 spot, we are looking at the crown jewel of the Mojave, Henderson. In May 2026, the city once hailed as the safer, quieter alternative to the Las Vegas Strip is undergoing a high-stakes recalibration. Henderson has always carried a premium. It's the land of master-planned perfection, from the windswept hills of Anthem to the glassy waters of Lake Las Vegas. But today, that premium is being tested by a cold economic reality. The average home value in Henderson has officially dipped to $486,156, representing a steady year-over-year decline that has caught many equity-rich homeowners off guard. While Henderson isn't seeing the chaotic freefall of the rural desert towns, the drop is significant because it's so widespread. We are seeing price declines of 10 to 25% in neighborhoods that were once considered untouchable. Why? Because the market simply hit a ceiling. Prices went too high too fast during the migration wave of 2024. And now the local wages and interest rate pressures have forced a massive pushback from buyers. The data is jarring. As of this month, a staggering 66.2% of all sales in Henderson are closing under the list price. This isn't just a minor negotiation, it's a structural shift where 2 out of every 3 sellers are having to blink first, just to get a deal across the finish line. The rental market in Henderson is providing its own reality check. In May 2026, the average rent has settled at $1,474. A slight year-over-year decrease that masks a much deeper cooling in the single-family home sector. For a 3-bedroom house in a desirable zip code like 89052, you're looking at an average rent of roughly $2,014. But here's the kicker. Landlords are increasingly offering concessions, with 1 month free or reduced deposits becoming common sights in Green Valley Ranch and Cadence. Investors who bought at the peak with high-leverage loans are finding themselves in a tight spot as the rental income fails to keep pace with their rising property taxes and insurance premium. But Henderson still holds massive long-term value. This is a city with a population pushing 310,000 and a reputation for being one of the safest in the nation. The infrastructure remains world-class, but in the short term, the math is being rewritten. We are seeing the median list price sitting at $524,981, while the median sale price is lagging behind at $178,000. This $50,000 expectation gap is why homes are now sitting on the market for an average of 39 days or longer. We've tracked specific price corrections in the upper mid-tier, like Seven Hills and McCulloch Hills, where homes that were listed at $700,000 are being chased down into the high fives. Buyers are no longer in a rush. They are walking through 5 or 6 houses before making an offer, and they are demanding that sellers cover the cost of interest rate buy-owns or major repairs. The take-it-or-leave-it era is dead. If you are a buyer in Henderson in 2026, you are looking at more inventory than we've seen in 3 years, with over 2,100 active listings to choose from. At number 2 is Sparks, Nevada. Sparks is the epicenter of a unique housing phenomenon. For years, it was the affordable alternative to Reno, a magnet for families and first-time buyers who wanted the proximity to the tech hubs without the $600,000 price tag. But during the boom of 2024, Sparks became its own spotlight, and prices surged so fast they eventually hit a ceiling. Now in 2026, that surge is reversing in a way that is catching sellers off guard. While the citywide median list price is still holding around $579,933, the reality on the ground is far more fragmented. In some specific parts of Sparks, especially the newer developments in Spanish Springs and the outlying areas, home prices have dropped by 15 to 30% from their absolute peak, and it's happening faster than many expected. Why? Because Sparks expanded at a breakneck pace. We are seeing a surge of new supply that the market can no longer absorb at 2025 price levels. Inventory has climbed to over 597 active listings, a massive increase that has flipped the script. When buyers have options, the take it or leave it power of the seller evaporates. The most telling stat of May 2026. Nearly 47.1% of sales in Sparks are now closing under the list price. The rental market in Sparks is also reflecting this new equilibrium. Average rent in the city has settled at $1,953. If you're looking for a family's 3-bedroom house, you can expect to pay around $2,434. A figure that is actually seeing some downward pressure as landlords compete with a wave of new apartment complexes hitting the market. We've tracked specific rental drops in the zip code 89434, where rents for 2-bedroom units have slipped back into the $1,800 range just to keep vacancy rates from climbing. What makes the Sparks correction so cinematic is the shift in days on market. Homes that once sold in a weekend frenzy are now taking an average of 68 days to find a buyer. That is over 2 months of price-reduced banners and open houses. Sellers are no longer just lowering their prices. They are offering aggressive incentives like rate buy-owns and covering $10,000 in closing costs just to stand out against the new construction. We've tracked properties on Draco Court and Circle that were listed in the high 600s and are now being chased down into the 500s as the speculative fever breaks. But let's be clear, Spark still has incredibly strong fundamentals. This isn't the end of its growth story. It's a necessary pause. With its prime location near the Tahoe-Reno Industrial Center and its superior access to outdoor recreation, the city's long-term infrastructure remains a powerhouse. At long last, we arrive at the epicenter of the desert correction, Las Vegas proper. While the neon lights of the Strip never dim, the residential neighborhoods behind them are flickering. The data for April 2026 is a bucket of cold water for anyone still believing in the infinite growth myth. The median sales price for an existing single-family home in Las Vegas has settled at $481,995. On paper, that looks like a minor dip. But when you peel back the curtain, you see a market that has officially entered a buyer-favorable transition for the first time since 2020. The most telling statistic in 2026 is the inventory explosion. Active listings in the Las Vegas metro area have surged by nearly 16% year-over-year, climbing to a total of over 6,256 homes currently sitting on the market. This has pushed the city to a 4-month supply, a level of inventory that has effectively killed the bidding war. In April 2026, the Market Action Index has dropped to a 34, signaling a clear shift where the buyer now holds the leverage. If you aren't convinced, look at the days on market, which is stretched to an average of 60 days. That is nearly 2 full months of a home sitting empty while the seller sweats through their mortgage payments. The rental market in Las Vegas is also experiencing a high-velocity downturn. As of late April 2026, the average rent in the city has plummeted to $1,618 per month. That is a staggering 4.9% decrease in just the last 30 days. If you are a landlord, you are watching over $100 of monthly income evaporate practically overnight. For a standard 3-bedroom house, the average rent has settled at $2,246. But even at those prices, units are sitting vacant. We are seeing a renters' revolt as over 17,000 apartments are currently available across the valley, forcing property managers to offer aggressive move-in specials just to fill the buildings. But why is the #1 city on our list dropping so fast? It's the great investor flush. In 2026, the short-term rental regulations in Clark County have finally reached a breaking point. Thousands of investors who bought condos and single-family homes to run as Airbnbs are finding the red tape and the plummeting occupancy rates unbearable. This has led to a flood of turnkey inventory hitting the market at the same time. We've tracked specific price bloodbaths in the older corridors near the Strip and in neighborhoods like Sunrise and Rhodes Ranch. We are seeing a 33% price reduction rate, meaning 1 out of every 3 homes listed in Las Vegas has already had its price slashed. We've seen specific sales on streets like Coffeeberry Court and Peaceful Pond Avenue where homes are closing at exactly the list price after months of waiting, or in some cases closing 4 to 5% under asking. The Salado-list ratio has flatlined at 0% over list, a far cry from the 10% premiums we saw just 24 months ago. In neighborhoods like downtown Summerland and Meadows Village, the high-end inventory is still commanding top dollar. But for the average bread-and-butter home in the $400,000 range, the floor is soft. In 2026, Las Vegas is no longer a place where you can slap a sign in the yard and wait for a bag of cash. Sellers are being forced to offer rate buy-owns, with nearly 1 in 3 closed transactions, including some form of seller concession, to help the buyer handle mid-6% interest rates. What we've just witnessed across these 10 cities isn't just a series of random data points or a seasonal slump. It is the sound of the desert air being let out of a decade-long housing bubble. In 2026, Nevada is no longer the Wild West of buy at any price. The landscape has shifted from a speculative gold rush to a cold, hard game of financial survival. Whether it's the 40% drops in the condos of Laughlin or the calculated retreats in the luxury hills of Henderson, the message is clear. The market is resetting, and the old rules are buried in the sand. For some of you watching, this is the moment of terror. Watching equity you thought was permanent start to flicker like a neon sign with a bad connection. For others, this is the moment you've been waiting for. You've sat on the sidelines, you've saved your capital, and you've waited for the for sale signs to start looking like white flags of surrender. But remember, in a market this volatile, being right is only half the battle. Timing is everything. Buying too early can be just as dangerous as buying too late. And in 2026, the bottom is a moving target. This is why your source of information is your most valuable asset. You need the boots on the ground reality, not the sugar-coated headlines from corporate offices. You need to know which zip codes are traps and which ones are once-in-a-generation opportunities. This isn't just about real estate. It's about where you're going to plant your roots and how you're going to protect your future in an era of unprecedented economic change. If you want to stay ahead of the curve, if you want to see the correction before it hits your driveway, you need to be part of this community. This is Where to Live TV, and we are the only ones tracking the pulse of the American landscape with this level of raw, unfiltered detail. We don't just show you the houses. We show you the math, the migrations, and the truth that the experts won't tell you until it's too late. Do not let the market move without you. Hit that like button right now if you value the transparency we bring to the table. Subscribe and turn on those notifications, because in a year like 2026, a single week can be the difference between a massive win and a permanent loss. Every city has a story, and every price drop has a reason. We're going to keep telling those stories, so you can make the smartest move of your life. The desert is changing. The prices are falling. The question is, are you going to be the one who got caught or the one who took over? Thanks for watching Where to Live TV. We'll see you on the next hunt.